Hi, this is Brian Dolan with the law firm Pepper Hamilton. Recently, Pepper partner Greg Nowak hosted an investment management webinar for West LegalEdcenter. This month, Mr. Nowak was joined by Pepper partner John Falco and Jay Nusblatt, managing director at Donnelley Financial Solutions, for a discussion tailored for registered funds and mutual funds that are subject to new reporting requirements. The panel also discusses their joint white paper regarding the recent rules on practical tips and strategies for preparing to comply with the new requirements. You can download the white paper and the PowerPoint slides used during the webinar by visiting Pepper's Insight Center at www.pepperlaw.com, where this podcast is posted. Thank you.
This is Greg Nowak from Pepper Hamilton. We're a full-service law firm located across the United States. And today I happen to be joined by one of my partners, John Falco. John, you want to tell us a little bit about yourself?
Sure. I'm a partner in Pepper Hamilton's Financial Services Group, primarily focused in investment management issues, particularly registered investment companies, closed and open-end funds.
And we're also very pleased to have joining us Jay Nusblatt from Donnelley Financial. Jay, tell us a little bit about you.
Sure. So good afternoon, everybody. Jay Nusblatt. I'm a managing director in sales and business development with Donnelley Financial Solutions. My core area of focus is the mutual funds industry, and we're very focused on SEC modernization and delivering solutions to the market. Prior to joining Donnelley a little over a year ago, I worked for 22 years at Bank of New York Mellon running the fund accounting and administration business. So welcome. I'm pleased to be here today.
Thank you, John and Jay. As many of you know, this program tends to focus on the alternative investment industry, hedge funds, private equity funds, but we also like to be very broad and address issues of concern and interest to the investment management community in general. Now, a lot of people say, why is that? And here's the reason. Our client base, composed of portfolio managers, oftentimes don't really understand the great divide between private funds and public funds. They just understand how to manage money. And they look to us to help them with the vehicles, whatever that appropriate vehicle might be. And so we believe it's important for registered fund managers to understand the alternative space and for alternative fund managers to understand the registered space. If anything, what the SEC has taught us is they often will roll out initiatives like the Modernization in Plain English initiative that we're going to talk about today in the registered fund space, because that's where the resources are. They essentially do a beta test with the registered fund industry and then will roll it out, if it makes sense, into the private fund industry. We've seen that with custody. We've seen that with other initiatives over the last several years. And so this is a way for the entire industry to come up to speed on one of these more recent initiatives. There are materials, as Emily said, on the tab, so we will loosely follow those, but we will also address some of the other questions that this initiative poses. And one question I have for Jay is, before we get into the nuts and bolts, let's just talk about the cost. What are we talking about that a registered fund manager can expect his fund to incur, which of course is a drag on performance, in order to undertake the modernization that the SEC is asking for here?
So, Greg and everybody, when the SEC issued their release for modernization back in October of 2016, there's some 500 pages of the release, and we've obviously poured through that in fairly good detail. Contained in the document is a discussion of what the SEC describes as burden cost, and what are the burden costs that mutual funds will absorb or have to contend with in conforming and filing Form N-Port to the SEC. And so those burden costs, they have various ranges per fund, but generally the costs were, anywhere between the upper $39,000 to $47,000 per fund.
And by that you mean per portfolio, not per registrant.
Not per registrant, per fund, per portfolio, for complying with specifically Form N-Port. That, I would just contrast those numbers. So again, it ranged from $39,000 to $47,000 per fund of burden cost. When Form NMFP came out in 2010, the SEC provided similar analytics of burden costs for NMFP, and that was approximately $30,000 per fund. So this has a higher burden cost than NMFP did previously, but I think for everybody on the phone that gives you some important and interesting benchmarking context around the cost. The SEC believes this will be more expensive to implement and manage than NMFP was previously, Greg.
Now, is this a one-time cost or an annual cost?
These are ongoing.
Ongoing.
And
$39,000 to $45,000.
Ongoing. And the SEC also has anticipated one-time expenses. They're contained in the release as well. The numbers I quote are ongoing, yes.
Okay, so that's the cost, and of course those are averages, right?
Well, they're estimates based on what the SEC thinks it will take to get ready, and then to actually implement and comply on an ongoing basis. So the reality on the ground may be much different than what the SEC.
Higher or lower?
My sense is that the actual leading costs for preparing for this are going to be higher than their expectations, because it does really encompass all of the aspects of mutual fund operations and management. With respect to ongoing, I think that the SEC estimate is reasonable. I think as we get further down and things become more automated and people become more this regime becomes more ingrained into their processes, the cost will go down, but I think that it's a fair estimate.
And is this replacing a cost that the funds are currently incurring, or is this an added cost?
It's the import is meant to replace some of the reporting requirements that funds are currently required to do in Form NQ and their Form NCSR and NSAR, and so. You won't have to file your NQs, which are done on your first and third fiscal quarters, but you will have to file the NPORT each month rather than quarterly.
So this goes from a quarterly filing to a monthly filing?
A monthly filing, including portfolio holdings information on a monthly basis. Only the actual fiscal quarter filings are the filings where the SEC will see it, as well as the public. The other remaining 8 filings will be not publicly disclosed.
But I would also add, and you'll see this as we get into the presentation, over the next hour, there are incremental data points that are being required by the SEC in Form NPORT that have not previously been reported. So it's my view, Greg, that the majority of the burden cost is in fact incremental.
So now that's the cost, and of course that's the government's estimate of the cost. What's the benefit? What's the big picture purpose, the forest for the trees, why the FCC thinks this is such a good idea?
Well, I think there's a number of reasons. I think the fund industry has kind of grown, and the
fund industry meaning the registered
fund industry has grown, and the types of funds out there and the types of instruments and the types of risks that these funds are subject to has changed. You see a lot more registered liquid alternative funds. You see, which essentially hedge fund strategies put into an investment company registered fund wrapper. You see managed futures funds where they're doing a lot of commodity futures trading, and so there's increased risks. There's more funds. There's more players. There's more, and I think the SEC is kind of updating their systems. They're trying to come up to speed. They're trying to use new technologies in order to gather information to regulate the industry. Importantly, as we've seen in the past with some SEC actions, they're using data analytics more and more, and in fact, it's integral to their enforcement side. I think that this is really intended to enable the SEC to gather data to inform them on regulation, on examination, and as well as enforcement. So this is this is the data gathering aspect to feed their analytical processes so that they can regulate the industry.
So more data is very much like the NSARs, right? Or not NSARs, the SARs rather. More data is actually better for them as opposed to less. So there's really no, from their point of view, regulatory burden associated with collecting more data. Jay?
Yeah, I think NSAR is actually a perfect point, because that's what I was just going to say, following up on some of the things that John mentioned. Just getting back to your question of why are we going through this? So a lot of the data that the SEC currently receives is on Form NSAR. So Form NSAR was developed some 25 years ago. It's basically a paper filing of data points that the SEC takes in. That form, in effect, is being modernized and updated to now be contained in Form NSEN, which is census-based data, but also information on import. So to John's point, we're getting away from a paper filing to relevant data about holdings that will now allow the SEC to view and potentially take action against events going on within portfolios. That the way the industry provides information to the SEC today through Form NSAR, it's very difficult for the SEC to be able to do that. So it really is modernizing how the industry is reporting, and hopefully we'll see benefits coming back, from the SEC's analytics as a result, Greg.
Now, John, you also mentioned that there was a change in the industry with more funds, different types of funds. Just so we're clear, this is going to cover all registered product, including closed-end funds, both interval and traditional listed funds, as well as traditional open-end funds, as well as ETFs.
Correct.
Does it cover money market mutual?
Money market funds have a separate periodic reporting requirement, and in a lot of ways...
Already in force?
Already in force, and in a lot of ways this is really an extension of that effort to modernize the data and move it from just mutual funds or money market funds to the other parts of the fund industry.
And I guess, the elephant in the room, the new administration has made reducing regulation and costs on business one of their centerpieces of how to operate. Is there any possibility here that this rule will be dropped onto the cutting room floor?
I don't think so. I think in a lot of ways this rule and the requirements make a lot of sense to both the industry and to the SEC. I think the regulator is going to get the information they need. As the industry gets used to complying with the new reporting requirements, I think it'll become just built into their processes. I don't see this as one of those areas where the new SEC commissioner is really this isn't a really controversial regulation in that sense. I think the use of the data and as they add on additional components and information that they seek by further rulemaking, that may be impacted by the new administration. But I think we're too far down the road.
So even the smallest funds are going to be incurring this cost. There's no exception for small funds or small formation or anything like that.
There is a implementation date difference. So for funds below $1 billion in assets, implementation date for NPORT is June of 19. If you're greater than $1 billion in assets, Greg, implementation is June of 18. So there's a break on implementation, but everybody has to comply.
All right. Well, that takes care of the forest for the trees. Now let's get into those trees, if you don't mind. For those following along in the slides, we're now going to turn to the overview of the rule. And John Falco, tell us exactly.
Sure. The rule was initially proposed in May of 2015 and then adopted in October of 2016. As we've discussed, it's introducing several new forms and new, and really, as we've stated, it's really in order to allow the SEC to gather additional data, and it also increases the periodic intervals in which funds are reporting.
Okay, but let me be clear here. I mean, if, it says goal, increase transparency and investor risk in the SEC's use of analytics. Let's say that the SEC's review of these forms shows that a particular fund has taken on a very risky position, or the fund is posing systemic risk because of the swaps or other positions that it has. The normal remedy that the SEC has had is disclosure. Make sure your investors understand the risk. Is there some implicit remedy here that they now have the data that they can use against the fund or the fund manager?
I think it modernizes the way that they get the information. They get it more frequently, and they get it more in kind of a data package that they can utilize. And so I think there's a number of things that there's a number of ways they're going to use the data. They're going to look at the industry at large, and they're going to look at the aggregate that the industry's invested in, and the risk that the industry as a whole is taking on from a systemic risk standpoint. I think that's true. They're going to look at individual managers and individual funds, particularly maybe some that they perceive to have more risk than other funds, and look to see if they're complying with their disclosure documents and the 40 Act. The 40 Act and the regulations.
So let's talk about the typical case. The fund is complying with its, contractual mandates with investors, and its presumed contractual mandates in the placement memorandum, in the prospectus, and the SAI. So there's complete disclosure, right? There's no issue there. What happens next? If the SEC sees that this fund has been, or in their point of view, believes that the fund is risky or posing a problem?
Well, I think it's an opportunity. I don't know that, I think there's different levels that the SEC can communicate with registrants. They can come in with a phone call saying, hey, we've noticed this, we have a few questions. On an informal basis, they could come in on an exam. They could come in on a Starbucks review of your financials, or they could take it up a notch and come in with an investigation or an enforcement action.
But what would be the basis of the enforcement action? If you've provided the data, it's fully disclosed, it's consistent with the deal you have with your investors.
Well, they wouldn't come out with an enforcement action before they've done an exam, right. They've asked questions, or they've initiated an investigation. But I think what it does is it gives them real-time or close to real-time data on a monthly basis to review registrants and be on the ground more timely than they would under the old reporting regime.
And I guess it does give us the opportunity for the SEC to have or see patterns across the industry, and once it sees those patterns, take either corrective action or issue notices or whatever,
certainly
drive normative behavior.
And so let me just jump into this a little bit. So you're both bringing up really good points around timely reaction or analysis. I'm going to sort of look at this not necessarily from an enforcement perspective, but just in terms of the SEC's ability to observe and analyze what they're getting. So and the SEC has actually said this, and we've talked to investment manager clients of ours who have spoken directly with the SEC. We have as well. The SEC is hiring data scientists who will be mining the information that is provided on Form N-Port. And so as data scientists in data analytics, they will be able to, in a much more sophisticated manner, analyze what is now being sent in. And so around some of the points that we're talking about, the industry is basically embracing that, yes, Greg, the SEC is going to react and respond to what they're receiving because they will have staff in Washington or wherever at the SEC that will be performing data analytics. I mean, legitimate data scientists that will be doing this work. So they are positioning themselves to react timely and to ask, logical questions, around, trends that they're seeing in portfolio construction, potential systemic risk as a result. And so Yes, and so that's just a little more background around how they're going to do it, and what they've been describing at various industry conferences around their gathering and analytics capabilities.
A housekeeping item of Sean and Richard, I hope you can hear us now. We have adjusted the volume of the device that we're using. If you could please send us a note if we're still having audio issues, so we could try to resolve those. Okay, so we understand that the rule itself does not have any specific enforcement capacity or capability included within it, correct? So we're talking about general SEC enforcement or review or investigation authority, but this does give them real-time or close to real-time tools in order to know what they're looking at. So instead of doing sweep exams on an issue, they simply pull their data from these forms. So it's pre-positioned data.
Sure. They'll get data on a monthly basis, and they'll be able to identify perhaps those registrants that might be subject to a more in-depth sweep exam and the like. But I think that it doesn't change the SEC's enforcement ability or its ability to come in on exam or its ability to issue regulations. It's just another reporting requirement that is replacing others, and there will be a transition.
So let's turn to slide 4 of the materials, where we focus on the new forms and the periodicity at which the forms have to be delivered. So tell us about Form NPORT.
Sure. Form NPORT is essentially the monthly reporting requirement. It replaces Form NQ. Unlike NQ, it has to be filed in XML, which is a computer language that permits that essentially can be pulled into the SEC's databases. That's filed monthly. That's the next form that is being adopted is Form NSEN, which replaces Form NSAR. That will be filed annually. Previously, NSEN was filed. NSAR was filed semi-annually, and will be. But this will only be filed once a year, 75 days after the fiscal year end of a registrant. They're the two major components of this rulemaking. There were also some other adjustments to Reg SX, as well as some conforming amendments to Forms M1A, N2, and N3.
So tell me about the moving of the disclosure from the notes to the schedule of investments for derivatives disclosure. What was the objective there? What were the changes to Reg SX?
Sure. I think that, and this has been an area of the SEC staff's, disclosure staff's concern in whether it's in the financials or in their reviews of financial statements. What they want to relay to investors are the types of derivatives and the exposure that the fund is getting with those derivatives. And so they would prefer to have them up more highlighted in the portfolio schedule rather than a position that indicates a net position on, for instance, a swap contract.
So positions now have to be shown gross, each leg?
No, you show them net, but they're pulled up further, and they're not. It's not just a net basis. You actually have to show a little bit of more information about the notional rather than just the net position. So it's more in-depth information with respect to the futures contracts, swap contracts, and other types of derivatives.
Now, this reporting, of course, Dodd-Frank changed the jurisdiction of the SEC and the CFTC governing swap contracts. So swap contracts on securities, single securities, and swap contracts on narrow indices are subject to the SEC, whereas broad-based swap contracts and swaps on anything else are subject to the CFTC. Does this rule apply to the commodity-governed swap contracts as well?
This is a reporting requirement with respect to the financial statements of the fund. It doesn't it's just if a fund holds those positions, it has to report them in a more detailed
whether or not they're regulated by the
regardless of the regulator. It's a part of their portfolio. It's got to be reported.
Now, what about funds that have wholly owned subsidiaries, many of which were formed for the purpose of turning, otherwise bad income into good income under Subchapter M of the Internal Revenue Code?
Sure.
Do these reporting rules reach down into those wholly owned subsidiaries?
I mean, typically they would, because the financials of the controlled foreign corporation are typically consolidated with those of the fund. And so it's a consolidated financial statement, and that information is reported as required under the new Reg SX requirements.
Okay, so now we're going to turn to slide 5, which is the compliance dates. Jay, you gave us a hint as to what is happening with these different compliance dates. Tell us, the first thing that we have to do, it looks like it's Reg SX reporting, which is for August 1, 2017.
Right. The Reg SX is really amendments to the financial reporting requirements. And so there is additional information with respect to funds that enter into securities lending arrangements with respect to the fees that they pay and they split with securities lending agents. So it really is just an update of the financial reporting requirements, and that does occur prior to the full implementation of the reporting requirements.
Okay, so but that's this summer, August 1, 2017. Tell us about the effective dates with respect to the NPORT and the NSEN, and can you comply sooner, for example?
The SEC is permitting. Let me start with the compliance dates. For large funds, those with more than $1 billion in their fund complex, the compliance date is June 1, 2018.
So this is measured on a complex-wide, not on a portfolio-wide basis.
If you have yes, that's correct. So larger fund complexes with more than $1 billion. Yes, it's on portfolio complex, not by fund. That's June 1st, 2018. So for NPORT, your first filing would be at the end of July, because your first monthly period would end on June 30th, and then you have 30 days to file your NPORT after that. For smaller funds, you get another year. Again, the SEC recognizing that there is a lot of lead-in work that needs to be done to get this process established, to do your monthly filings, understanding that the larger funds will probably clear the path for the smaller funds, and they don't have perhaps the resources to do that. So hopefully most of the issues are fleshed out with the larger fund complexes, and the smaller funds can take that year to prepare and come in. And I would imagine the SEC, either formally or informally, would do some type of frequently asked questions with their experience on the implementation with respect to large funds to kind of inform the industry on how to get further.
But let's take a step back for a second. For the last 10 years or so, we've had a lot of funds formed as part of series trusts that are sponsored by administrative firms or others. In those contexts, I'm assuming this compliance date is going to be measured at the series trust level as opposed to the individual series level, and so therefore the individual series will be required, even though they may only have $100 million, they're still going to be considered a large fund if the complex is over $1 billion.
It'll be looked at the registrant level in the case of a series trust, and that's consistent with the model of a series trust, is that you have a number of advisors that are sponsoring funds that sit on this platform without an overarching advisor sponsoring the fund. So the idea there is it's sort of a fund condominium, and they share the expenses of a complex, and they take care of their individual condo and what's inside and how they manage the fund. So I think To your answer, yes, it'll be at the registrant level, not on the individual series within that series trust.
So that's an important takeaway for the managers on the call. You may be managing a small mutual fund that's part of one of the large sponsored series trusts and think that you have more time. You don't, because your series trust is going to need to comply at the earlier date, which is next June 18th.
Assuming that it has
more than $1 billion, right? Exactly.
I wanted to go back because there is, you were talking about early compliance with the rule. There is a 6-month lead-in period where the SEC is going to permit registrants to test file, and so that they can prepare form NPORTs and submit them through EDGAR. They won't be publicly available. But there is a period where you can test file. And then after that, I think there's a 6-month period after that where none of the filings will be made public. It really is kind of the kind of they're going to get people to start the filing, start the process, see how it's going, and then so the filings for the first 6 months will only be viewed by the SEC, and that gives them some time to see how things are going before information is pushed out to the public.
And the same thing happened with NMFP. So with NMFP, for the first, the SEC didn't come out, I don't believe, with any formal 6-month window, but they were very flexible in providing comments back in the first 2 months of filings. So, Greg, to your question and what John is describing, as we've been, interacting with our clients in the industry, we think that first 6-month window is going to allow, a lot of the kinks to be worked out so that this really does get perfected by the end of that 6-month window, and these filings really get put up on the rails, and they don't get completely put on autopilot, but a lot of the fine-tuning will occur during that first 6 months, and because that information is not being made public, it really affords the industry to manage the filing accordingly.
And I suspect that that's also helpful to the SEC because they'll be able to see in large part what the large fund filers are providing and how they're responding to specific items. And if it's what they expect, then that's great. That works. But if they're seeing deviations in the responses from one registrant to the next, it gives them the ability to think about ways to get the industry to consolidate. So the industry really is providing the same apples-to-apples information in connection with a response to an item.
All right, so we went from the forest to the trees. Now we're going to start peeling back the bark. So tell us about new form NPORT.
Sure.
But this is slide 6 for those following along.
Sure, and we're really not going to get totally into the weeds because that would put everybody on this call asleep. There's several principal reporting components, similar in some respects to other SEC reporting forms. There are some additional disclosures with respect to those funds that hold more than 25% of their assets in debt. So there'll be additional information with respect to the fixed income securities that a fund is invested in. In addition, there'll be some disclosure related to recent rules that were adopted with respect to liquidity management programs, where the funds have to disclose the liquidity levels in 4 categories with respect to whether or not they're liquid or they're really, really liquid, and then 2 intermediary liquidity assessments. Derivatives disclosure is significantly increased, and this is an area where the SEC is really asking for detailed information on the contract, the counterparties, the reference assets, the notional amount, how the particular contractual terms of the derivative are set. And I think this is an area where those funds that are using derivative instruments are really going to need to make sure that they are in communication with the various parts of their fund operations, whether it's the portfolio managers that really understand the derivative positions, fund administration, and which really understands how they're accounted for and how they're valued. And there will be some work in that regard to make sure that all the data is gathered and collected and push forward into the form in a way that is compliant with the new form. Again, registrants offering multiple series must file separate reports on each series. If you'll recall, for NQ and SAR, you can file one report for one filing for all of your for all of the funds on your platform. Now you will need to file a separate NPort for each fund. Again, I think that's so that there is a clear information with respect to a particular fund instead of a data dump. I think that helps the SEC in processing the data, but it also helps for those reports that are made publicly available. It makes it easier for investors to read the reports and understand the particulars on the fund in which they're actually invested.
What's the penalty for a late filed NPort?
I don't know that there's any specific penalty, but again, the SEC has the ability to issue civil penalties for noncompliance with its...
Or shut you down, or cease and desist order on the fund, or any of those other things, right?
Well, I mean, I think typically you have the ability to delay a filing and report to the SEC that the filing will be delayed. And you would give notice to the SEC that you're unable to make the filing. I would imagine, though, that the first time you're late is not going to result in the shutdown of the fund, particularly if you have a good reason, and particularly if it's in the beginning of the compliance dates, and it's more of a technical issue than not complying for bad reasons. But I think we're talking about technical filing requirements. I think as you fix the issues and file timely, I'm not sure how the SEC is going to react with respect to a late filing, but I don't see it being.
But there's no specific penalty specified in the regulations.
There isn't, but I mean you haven't complied with your filing requirement.
Right, of course.
And so it does impact your registration status with the SEC. That could impact your ability to offer shares because you're not complying with the which
is of course a bigger penalty than any type of civil fine.
Sure, but I think you're out there, you're selling a security, and you're making the claim that you are a registered fund fully compliant, and you have a prospectus out there, and you're selling off of that. To the extent that you're not making the appropriate filings, over time that becomes an issue, both from a regulatory standpoint and from a liability standpoint. That being said, again, I think the industry will comply. People won't miss these filing dates. There may be times when you'll have to notice the SEC that you're going to be late with respect to a portion of the information required because you only have 30 days to gather the information. And if you don't have the information or it's not in a state that can actually be submitted, you may have to delay filing with respect to that portion and then amend your NPort after that fact to catch it up with the appropriate information. So, I think it's very similar to the filing requirements we have with other reports to the SEC and the ability to notice filing and get a small delay in submitting the filing.
So 12 monthly reports every year to the SEC on the NPort. Fiscal quarters, however, are made public on a 60-day delayed basis. Any prognostication as to what the industry is going to do, or the hangers-on the industry, the commentators, what they're going to do with the information on a 60-day delayed basis?
Well, I mean, the most important information that is being made public are the portfolio holdings of the funds, and they're already being disclosed publicly. There is certain information that won't be released, even on the quarterly basis. So I think people will make what they will with the information they have, but I don't know that it's going to be a big difference with respect to the pundits, I suppose.
I would just say a couple things on this. The public disclosure has actually been, some of the controversial aspects to the rule. And in the comment,
well, it gives away the secret sauce because you could reverse engineer the portfolio.
In the comment period, and this was all fully disclosed by the SEC, there were a number of registrants who objected and provided commentary around public disclosure and trying to pull that back. And the fact is, some of that did get captured in the final rule. We actually posted on our website a blog post around exactly what information is being publicly disclosed, and just some of our commentary about it on dfsco.com. You could log in and see that blog that we talked specifically about what aspects of the form are public, and just some of our own commentary about it as we try to blog around different aspects of these rules that we see, Greg.
So whether or not the information finds its way into some public database, we don't know. But it is more data that's available to the commentators and others in the industry who will decide whether or not it makes any sense. Okay, so let's talk about new form NSEN.
Sure. NSEN is similar to NSAR. It's an updated census request for registered investment companies. As I said, there are certain additional information required with respect to closed-end funds, SBICs, small business investment companies, ETFs, and ETMFs, which is a newer version of they're exchange-traded managed funds. It's a newer version of exchange-traded registered product. You'll need to disclose with respect to NSEN some of the additional information with respect to any support that a fund receives from its affiliates, typically their investment advisor or fund sponsor. Similar to money market disclosures when fund sponsors and advisors supported the money market funds in order to either maintain a dollar NAV or at least a small return by rebating back either fees or providing capital support in the event the NAV deviated.
John, I don't want to gloss over this. We say here SBICs are now going to be subject to NSEN reporting. These are private funds. Normally they don't have a registration in place unless you mean an SBIC with a BDC overlay.
Well, typically certain closed-end funds and BDCs do invest in SBICs. So it's the information with respect to those investments. It's not the
SBIC itself.
Right.
Okay, because that's a very important distinction that everybody oftentimes misses. The SBICs have a hallowed status under the federal securities laws.
Sure.
And we don't want to.
So there's going forward, there's additional information with respect to some of the exemptive rules in which funds comply with, so that the SEC has more detail regarding funds reliance on certain rules. These again, NSEN is filed in the XML, which is the extensible business format.
Tell me about this line, financial support from certain affiliate entities is a new exhibit. What exactly are we talking about there? Are we talking about fee waivers? Are we talking about fee reimbursements? Are we talking about, support of a mutual fund that's broken the buck? I mean, what exactly are we talking about?
Well, I think it's similar to that. It's essentially the carryover from the disclosure requirements with respect to money market funds, where you did have sponsors support money market funds at certain times because of the market disruptions. It's the same thing. To the extent that a sponsor is providing some type of support, capital support or otherwise, to a fund.
What about waivers and reimbursements?
Well, waivers.
Traditionally, that's the way a manager supports a new fund. It does a fee waiver or maybe even a fee reimbursement.
Sure, but they're contractual expense relationships. The advisor it's fully disclosed in the prospectus already. I think this is more of a requirement to disclose capital infusions or some type of financial support outside of the normal contractual arrangements of the fund.
So a capital infusion to support NAV or particular expense?
Well, you could have an instance where there may have been an NAV error and the fund needed to be made whole. And so there may be a requirement that you disclose that one of the vendors or the advisor, made the fund whole. Again, this is really a disclosure with respect to real extraordinary support of funds.
Yeah, I could see a lot of resistance to that in the industry, where oftentimes the manager doesn't want to air its dirty laundry, right? There's a mistake, there's an error, they fix it. Now, that's not going to go unreviewed.
Well, it's a disclosure requirement. It's not, and it's a disclosure requirement, I'd say, and each particular event needs to be reviewed against that particular support, and determine whether or not it's required to be disclosed under the SEC's NPORT form.
We have gotten a question from our audience. What are some of the key challenges filers face with the new NPORT requirement? And I assume that would also similarly apply to the new NSEN requirement.
So I'll start. I think as we've been talking to our clients, there's a lot of focus on data. And so, data collection, is first and foremost. And, for investment managers, one of the things that we're seeing is there are disparate systems that house different pieces of data. And so one of the things that people are focused on is potentially installing an enterprise data warehouse at the investment manager so that they can create, in effect, a golden copy of a data point so that it can be reused. Reuse of data, Greg, is a real big issue that people are concerned about because you're going to be using a data point in your financial statements, now in Form NPORT, in NSEN, and other regulatory filings. And I'd say the only other point is, now that we have it, how are we going to aggregate that data and get it into Form NPORT? So I think, on the question that we received, key challenges, I think data management is really one of the key challenges that people are facing and finding solutions to help them manage that.
What about validating all those data points and making sure it's consistent across the various databases and uses? Is that yet another cottage industry that the industry is going to have to deal with?
It is, and it's really a major concern that our clients are talking to us about. And the context is the following. We're filing more information, and we're filing it more frequently to the SEC. So how do I know? And now the SEC is going to actually, it's not that they weren't, they're going to take action potentially on what we send them. So I need to make sure it's right. So how do I do that with the increasing volume of data and increasing frequency? So part of what we're doing here, and I've got some slides to go through this, but I'll just cover this now, which is actually on our slide 8. We're creating a dashboard for clients to be able to view where they are in the context of producing a filing, but also we're going to have data analytics around validation. So is this right? We are working with our clients to write validation scripts so that we can clear items through the process so that the registrant, in effect, is not having to review data point after data point. We're going to let the system do that for them. And then only flag true items that will require validation and review by a client. What we're being told is that it's really the only way that people will be able to survive increasing volume of data, increasing frequency to a regulator who's now going to potentially take action against your information.
But all that data still even though you have an outsourced solution, is still the responsibility of the registrant and the portfolio, right, and its sponsor and the managers of those entities. And notwithstanding everybody's best efforts, we all know that
mistakes will happen.
Right. So finding the mistakes, validating, the proper answer, and making sure is obviously, compounded because you're doing it at least 13 times a year, right?
Correct.
12 times for the end port and 1 time for the end send for every portfolio, right?
That's correct. So having the ability to validate, in a fairly sophisticated and automated manner that we're truly looking at red flags is something that our client base is yearning for, and we're working real hard at coming up with solutions in that regard, Greg.
John, does the manager and the fund company and the fund board need to modify their code of ethics, their policies and procedures, anything that they currently have in place from a legal and regulatory point of view? Because I know there's oftentimes agenda lead time to get those types of items onto the boards of the board of directors meeting the agenda.
I think that this far away from the compliance date, the way there are boards are being informed about the new requirements. They're receiving typically status reports on preparations for compliance with the new reporting regime. There will need to be a compliance process built into the fund's operations, and so
now, is that compliance process part of the $40,000 of portfolio that the SEC took into account, or is that something in addition to the upfront compliance?
I mean, I think part of it is built into that, but I think this is really just making sure that your policies and procedures recognize the increased reporting requirements and of NPORT and NSEN, and that you have appropriate procedures in place through at the fund level, at the advisor level, at the other service provider levels to make sure that you comply with the rule on an ongoing basis. So the amount of reliance that you for compliance that you have with respect to your internal resources versus your external resources is going to really inform the amount of work that funds need to do with respect to that lead up.
So Jay, walk us through, and we have about 7 minutes. Walk us through a solution set that you see. And specifically focusing on the modernization solution, data flow, the ARC filing concept.
Okay, so on slide, I believe it's Greg 10, where it says SEC modernization data flow. We've broken down the data contained in the form into 3 buckets of data. So static data, financial information, non-financial. So the static data is information that generally doesn't change.
The name of the fund.
Filing, name of the fund.
Strategy.
We get it in once, and we're good to go. We just need to update it. Financial information is basically the core fund accounting information, trial balance information. That is information that's really already being reported and contained in the financial statements. So you
need a data feed from the administrator and presumably from the accountants as well.
Correct. And so we're already getting that, or the industry is already dealing with that because it's preparing its financial statement.
And that's already in a language that's easily moved and manipulated to meet these new reporting requirements.
So we have the industry has a very good handle around the financial information. The non-financial is really where a lot of the incremental calculations are. So there's some. Let me get the easier ones out of the way first. So there's non-financial information we consider fund performance. There is repo collateral information that's required, securities lending information that's required. That we have that, the industry has that. We just need to get that moved into the NPORT form.
Where are we getting the data?
That's generally coming from the administrator or from the custodian.
From the custodian.
Okay. Now you get into other non-financial information, and if you were to turn the slide to the next slide of 4 broad categories of data, this is generally the majority of the additional non-financial. And so it's additional reference data. So I'll just highlight, for example, LEI of the issuer. So LEI of the issuer is not really being disclosed anywhere today. The SEC wants that for Form N-Port, just to show you some of the incremental reference data points. And generally, LEI of the issuer, Greg, is not contained in your asset master, in your NAV calculation, in your fund accounting system.
But we're talking about the LEI of the issuer of the instrument held by the fund.
Correct.
Okay. Just make sure we're not focusing on the fund itself.
Moving left to right, so risk metrics, there are incremental risk metric calculations, DV01s, DV100s, delta calculations. Some of these are currently being performed by fund managers, but again, these are new calculations now that we are providing to the SEC. And so a fund company needs to find a provider who can perform those calculations. There are administrators who are going to be performing these calculations. There are other third parties. We happen to be partnering with Interactive Data, ICE Data Services, who has the wherewithal to perform all of these calculations on behalf of registrants.
So time out for a second there. Most fund managers already have a suite of risk metrics that they use.
Yes.
Otherwise, they'd never get an institutional investor. So are we plugging into something that's readily available, or is a fund manager going to have to go out and bolt this on?
So there's a couple dynamics there. So they very well may have it internally, but being able to extract it every 30 days and verify, validate, and approve is now a horse of a different color. So now all of a sudden, an outsourcing to a third party for that becomes appealing, okay, as a potential. Secondly, there's another dynamic. So for an insurance fund family or a sub-advised platform, we have the same holding across multiple sub-advisors that may have different calculations on these risk metrics. So by hiring an independent third party, who theoretically is Switzerland, they will come up with one consistent calculation for that holding that's held across the multiple portfolios.
It'll also tell you where you have inconsistent positions.
Correct. So let me just keep moving because we're going to run out of time. Yeah. There's incremental taxonomy calculations that have to be performed. These don't exist. These are prescribed by the SEC with the calculation logic in the release that came out last October. And then obviously there's incremental other calculations that have to come into Form N-Port, piggybacking off of the liquidity rule that came out from the SEC. There are components of that required to be reported under Form N-Port. And so there's incremental subscription data that investment managers can subscribe to get their hands on. So again, it's static, financial, non-financial. That's a review, Greg, of the majority of the non-financial.
So we have all that data, and you need some way to put it into the meat grinder and come out with something that looks better than hamburger, right? And I'm assuming that's Donnelley's solution.
That is our solution, Greg. You see on slide 12 is a view of our dashboard. So we're going to present the findings. So we've taken all this data in, we're loading it. Is that good? Is that clean? How are we doing there? We now have exceptions that we've identified based on some of the prior statements that I have made. And we're now presenting, here are the red flag, the exceptions that we need to clear and fix. How much of that has been resolved, giving our clients a view of how many of these have been approved, and lastly, how many have we actually hit the send button to the SEC. So with the volume of information, the frequency of the filing, our clients have told us that they want to live inside of a dashboard to help them manage the throughput and manage where am I along the process, so that we don't have to have a discussion with John Falco. John, it's day 31 and we're late. What do we do? Right. That call from Greg by displaying this information from a production perspective. Where am I on day 30?
So the last slide is key milestones and checkpoints, and this is a good thing for you to take and paste on your wall, because over the next 2 years, if you're managing or involved with the management of a registered mutual fund, you need to be ready to hit all of these dates. And if your current series trust manager hasn't talked to you about how you're going to either use their risk metrics suite or how they're going to be able to get the data out of yours, trust me, that's not going to happen overnight, and you are going to need lead time to make that happen. So this is something really that you have to get on today and in the next month or so, because 2017, June, for your Reg SX is going to be here sooner than you can blink, and then your first compliance date in 2018 is going to be here faster than you can imagine.